Right, good morning. It's 11 a.m., so it's time we got this going. James is having a well-earned break this week, but he'll be back to talk to you next week. In the meantime, you obviously got myself, Matthew Reed, and Richard Williams. We're going to run through this week's news. It's been a sort of relatively quiet week in investment trust land. The sort of more interesting stuff, more exciting stuff, has obviously been in the property space, and Richard's going to come back and sort of talk about that in a minute. After that, we're going to bring on our special guest for this week, which is Kamal Warwick, head of equity research, or equity fund research, I should say, at Canaccord Genuity. He's a very interesting guy. He's got a lot of interesting things to talk about. So he added, or sort of asset allocates there. He's going to talk to us about sort of house views, the areas they like, where they're overweight, underweight, etc., etc. So that should be very good. First thing I'm going to talk about is the renewable sectors. As I say, it's been a quiet week, but we've had a number of updates. Q1 results for sort of Octopus Renewables and Bluefield Solar. Similar thing for HydrogenOne, and a sort of update on dividend target for NextEnergy Solar. There's also been an update on US Solar this morning. Basically, the sort of formal sales process for that has been terminated. And then, as I said, we're going to get Rich back to talk to you about Civitas social housing and home REIT. So first thing, let's look at Octopus Renewables Q1 results. And the reason I want to talk about these is that they just kind of highlight a number of trends that are interesting for the sector, certainly sort of since the beginning of this year. Now, the NAV day is down a little bit, it's down a couple of percent. Looking at this, you can see the sort of big move here is sort of 2.9% down, which is basically due to a reduction in power price forecasts, particularly from the 23 to 25 period, but I'll go on to that in a bit more. Slight negative impact for inflation. Once again, this has been a big positive for a lot of these funds recently, but perhaps there's sort of signs of that unwinding. Positive, small positive, 0.4 pence. Unwinding of construction risk premium. Now, this is basically where, and this is where sort of a lot of funds are, where they're moving more into the construction phase, are getting uplifts, because as projects get de-risked, you can apply lower discount rates and it gives a uplift in the NAV, and that obviously impact of the dividend. Now, the interesting thing for obviously Octopus is that it's got a higher proportion of contracted revenues. It basically says that around 78% of its revenues are fixed over the next 2 years. Now, super high visibility of this. The sort of big thing, as we were saying, is that actually it's on the other, if you imagine 22%, that you're sort of seeing the change here, which is impacting the NAV. And this is sort of particularly over the 23-25 period. That's where the sort of forecasts have changed. But it's reflecting the fact that it's got this high proportion of contracted revenue. So a lot of it is not subject to the vagaries of the power price. It says, sort of quote unquote, this decrease would have been significantly higher without the benefit of the fixed price power sales contracts within the portfolio. And I think, you know, this is something that's perhaps got to sort of read through or read across to a lot of other funds. So sort of something to be aware of. Key thing here is that actually the decrease is not all even. And once again, it sort of reflects on the underlying markets, but a big chunk of that is Sweden, Finland, and the UK. And basically, this is where the exposure to variable pricing is higher. It's got assets in sort of France, Germany, Ireland, and Portugal, and basically all of those 100% fixed price, or have got caps in place. So it really doesn't matter. So I think the sort of key takeaway is just have a look at these portfolios and just be aware of where the assets are located. Want to have to sort of look at these inflation assumptions as well, because there's some differences here. Into the UK and Poland, the assumption is that inflation is sort of coming down slightly, but actually they've raised it in other European markets. I think that's sort of quite an interesting thing to note. The other big item in that line, if I sort of go back a few pages, is sorry, I've managed to mark that up. Oh yeah, is the other movement, 2.7p, and I just wanted to talk about that a little bit, because it's obviously sort of quite a big positive there. Now 11 million of that, or 11 million of the 15 sort of million gain, which corresponds to 2.7p, just represents moving forward a quarter on the cash flows, which is sort of quite interesting. And perhaps there's sort of more read-throughs on that. And then the other sort of 4 million reflects the fact they've signed a sort of PPA. So on the Breach Solar Farm asset, which we sort of covered, and that's a long-term PPA with Iceland Foods. Obviously that has had a big impact. And, you sort of get a feeling of the impact that actually getting these deals in place in current environment can actually provide. As I said, if you sort of look at this, you can see, obviously, for a long time, the share price was above the NAV. Now, actually, the reverse is very much true. And this is a trend you're going to see. I'm going to put a few more of these charts up elsewhere for the other renewables fund. And this is a sort of prevailing factor. So they are cheaper than they have been for a long time. And it's fairly decent yield, 5.6%, 4.3% discount to NAV. As you can see in the sort of chart above there, you can see where it's moved to discount. It's not at the widest discount it has been, but actually there's a clear trend of moving from a premium to a discount, really during the last couple of years. So, food for thought there. Looking at Bluefield Solar, similar sort of thing. This is just taken from their annual report, but it's not their annual report, their Q1 results. Similar thing, power curve updates. This is literally, they've got 3 independent forecasters. All of them are saying that the sort of price is coming down, and obviously predominantly its assets are in the UK. Similar sort of thing, perhaps not as dramatic, but actually, once again, this was trading at a significant premium, and now it's trading at a sort of more modest discount, and that's a trend that you're going to see. As I said, all 3 of their independent power price forecasts have lowered the power prices for the near term compared to what they sort of previously published, but all other assumptions remain constant in that. They have already sort of guided 8.4 pence per share dividend for the year. They've sort of paid the first half of this, so 4.2 pence paid so far. And they're saying that actually they're on track to do that. Similar sort of thing, 4.7% discount, 6.2% yield. NextEnergy Solar. Now this sort of is a slightly different message, which is literally purely on the dividend target. Obviously, no results update there. But they have put out their dividend target for current year ending 31st of March 24 at 8.35 pence per share. That is 11% increase year on year. So that is pretty punchy and arguably reflects the fact that obviously there is a fair bit that has come through in terms of inflation uplift. This dividend target is forecast to be sort of 1.3 to 1.5 times covered. So, despite sort of certain worries, plenty of coverage there. Once again, supported, as you sort of tend to see across the sector, by higher visibility of revenues. So they are saying, 50% of this is RPI linked. And so they know that is coming through. And then obviously the rest is from budget generation, prices for 88% of which have been fixed through to 31st of March 24. So once again, very, very highly visible. They obviously have a lot of confidence in those sort of coverage ratios they're projecting. And we have sort of covered this off in our news, but they are talking about this sort of asset recycling program. And all of these dividend forecasts are not affected by that at all. It is not dependent. Obviously, all of this is locked in, so they are very, very comfortable with that. Similar sort of story. If you look at this, it has sort of previously changed or traded at a chunky premium for some time. It has been trading at a discount, and the discount is now markedly wider. But actually, recent NAV uplifts have sort of by and large held on, as you're seeing elsewhere. Just to sort of underline the confidence they've had, they have said in deciding the sort of latest dividend target, the board has considered future projected cash flow, or sort of future projected power prices, price hedges, inflation, renewable markets, historical budget, technical, financial, and operation performance of the portfolio, and obviously the ratio to cash cover to proposed dividend payments. So I think fundamentally the message is cash flows look solid. It's on 11.4% discount, offering a 7% yield. HydrogenOne, so Q1 results, 2.8% increase in NAV over the quarter, and sort of fractionally more over the year. Obviously, there's been a lot going on in this space, and there's a lot of sort of positive news coming through recently, but equally they've been concerned. So I thought it's actually worth just talking about this. They're basically saying that they've seen increase in the valuations of both their private and listed hydrogen assets. I've sort of got a little chart of the movements, and obviously there's 1.14 pence in there for the sort of investments advisors carried interest. I mean, this is very much a sort of feature of the sort of private equity space, and obviously that reflects the sort of private assets. But actually, the sort of key message here is there's a sort of finally a chunky move up, and it's mostly actually these assets moving forward, plus obviously foreign exchange impacts. They've got obviously assets in Germany, etc., etc. And obviously you've got expenses and the carried interest as well. Things are sort of driving this. They say there's a positive industry outlook. You're getting macro tailwinds from supportive regulatory regimes in the US and Europe. Example of this, UK government has just selected 20 green hydrogen projects as sort of funding candidates. It's also, they're sort of seeing growth in the underlying portfolio. So 40 million in total revenue in the year to March 2023, which is more than doubled in the year. Other sort of key highlights in terms of what it is doing. It's only its sort of first investment in clean hydrogen production in Germany, which is something you can sort of see on the site. We covered that news story off. They continue to make investments, 5.4 million in the quarter, and they've got plenty more cash to deploy, so now 12.5 million of cash and cash equivalents. And at the end of the quarter, they had 3.8 million of listed hydrogen assets, which is obviously a development from where they were. Key thing is portfolio continues to perform in line with expectations. Now, next I wanted to talk about US solar. Sort of big news here is that as of this morning, that this is sort of no longer officially for sale. For those of you that sort of may or may remember, back in October, they announced a strategic review, and there were sort of three options put on the table, basically. One, that they could just sell the portfolio as is, and then presumably wind down the company. They could sell the company in its entirety, or another option was to look at replacing the investment manager. They've now sort of provided an update, and here are the sort of key takeaways from that. So, in essence, the board said it is yet to receive any formal proposals to buy the portfolio that it considers to be in the best interest of shareholders. Now, I think the read through from that is that the prices they are getting offered are just too low. So clearly there is some interest, but there's not yet a meeting of minds. And they say discussions on a potential asset sale are continuing. And clearly it says that there's also remains in discussions about change of investment manager. But really there's sort of no further look through, don't know quite what's happening with that yet, but obviously say discussions are ongoing. Board also says they received a possible all-share offer for the company, but at a significant discount to NAV, so much so that the board unanimously rejected it. Given that it no longer has any possible offers to buy the company on the sale, it says that the sort of sale process is now terminated. Just to look here, I mean, this is perhaps more extreme than the other funds we've seen, but once again, the NAV is holding up pretty well. Yep, there's some variability, but the share price has drifted down dramatically during the last 2 years, which really has sort of opened up this discount, which I think is the core problem. It was certainly a key thing that the board said was sort of driving them to initiate the strategic review in the first place. I mean, this is something that we've sort of struggled to understand a bit, and I'll explain why. But overall, we sort of took the view, encouraged to see the board trying to improve shareholder value. But as I said, we've struggled to understand why they would want to potentially sell out. It doesn't really feel like the right time. So if you sort of look at the US, it's fundamentally different the way that it works to the UK. But nonetheless, it's a sort of well-established and understood market. I guess the sort of key difference is where in the UK, you will tend to see ongoing subsidies linked to generation, that kind of thing. In the US, you get a sort of one-off upfront tax incentive to do it, which effectively sort of subsidize the production. And then once these things are established, they tend to be much more based on long-term PPAs. So you've got sort of real solidity of revenue. But obviously, it tends to be sort of inflation, that kind of thing. But you haven't sort of got the vagaries of the power price. Equally, if power prices move up very strongly, you're not going to benefit from the upside. So it's a sort of fundamentally different way that it works. But whereas it may have been under a bit of a cloud during the sort of Trump years when he was sort of very negative on renewables, etc., much more pro-fossil, you've now got obviously Biden administration, which is very pro-renewables. So recently announced the Inflation Reduction Act is offering 370 billion in renewables tax credits, and USF and funds like it should be well positioned to benefit from this. I mean, I saw some stats this morning saying 90 billion of this has already been deployed and it's created 100,000 jobs. I mean, it is a sort of big stimulus there. And I think on the other side is they're sort of saying they're struggling to find buyers. I mean, this sounds sort of bit odd. But equally, if that is the case, if they are having difficulties, it may be the case that actually they can't find buyers at the right price because of this negative sentiment. I think at this point there are so many reasons why you would want to sort of hang on to this, that we'd kind of like to see the board focus on getting the message out on what the scale of the opportunity is in the US, and just making investors more aware of USF. I think if they're able to do that, that should close the discount over time. Now, hopefully, we can bring Rich in to talk about Civitas Social Housing and Home REIT. Rich, you there?
Yeah. Hi. Thanks, Matt. Yeah. So, seems to be I talk about Civitas on the show more than I talk about anything else. Always in the news, and then again this week with a bid for the company, which probably isn't that surprising given that it's trading on a massive discount and has been for a long time now. The bid come in at 80p a share. It's valuing the company at 485 million, but that's a massive discount to its NAV, which it updated this week as well for the end of March, of 26.7%. Obviously, when I talked about the discount that is on, it's at a massive premium to its share price, just showing how far how wide that discount had got recently. The board have recommended to shareholders to get behind the bid, but I just wanted to put this quote up from the chairman because it's quite surprising, really. So it believes it undervalues the long-term prospects of Civitas, but then obviously talks about the challenges within the sector and sentiment towards that sector, and unlikely to overcome that in the short to medium term, which was something I don't know if your definition of medium term is like mine, which is sort of 2 to 5 years, then I'm not sure I agree with that. I can see with the strengths and the fundamentals of this sector, and the good that this is doing and the need for it, that things will start to look up in 2 to 5 years' time. So I'm not sure I agree that it can't overcome this, and for that reason we believe this offer is way too low. We go on to the next slide, Matt. So like I said, yeah, we believe this bid materially undervalues the company and its long-term prospects and its medium-term prospects, actually. Like I said, fundamentals are still really strong in this sector when you look at the demand for the properties that Civitas provide. It's not going away, it's only getting more intense, and the supply of these are really severely short as well. So there is that supply and demand tension there. There's also, like I said, a great need for it, and there's no real alternative. Although the regulator has obviously been vocal about the strength of some of the housing association tenants, and rightly so, there still really is no alternative for this, and for that reason, I don't think it's going to go away. So, I mean, what we'd like to see is a counter bid. Obviously, shareholders to reject and the counter bid to come in sort of much closer to NAV. And if we look at, on the next slide, if we look at the bidder, so the bidder was Wellness Unity. which is a subsidiary of CK Assets, which is a Hong Kong-based investor, and they've been investing in, well, all across different sectors stuff, but quite big in real estate, quite big in the UK as well, and that they own a portfolio of social housing already, which, funny enough, is managed by Civitas's manager, Civitas Investment Management. And in the announcement, it also said CK Assets also owns an indirect shareholding of Civitas's manager. So there is that as well to consider. And we look in the next slide at how Civitas has been doing. I mean, like I said at the start, I think I show this this graph more than I do any others, but it has been through good times, especially sort of during COVID in 2020, halfway through 2021. It was trading at a decent premium because of the government-backed income, the strength of it, the inflation protection in there as well. And then we had in sort of towards the end of 2021, the short seller attack, which really hit its share price, as you can see. And it's just not recovered from that. There's been the regulatory updates on some of its tenants, even though you see the NAV ticking up, come down obviously at the end of last year when interest rate rises and things like that. But the discount widened to 50%, which would attract opportunistic bids like this one. Obviously, it's gone back up to 80p now, still way below NAV, and like we said, we think it's too low. But talking about opportunistic bids, if we go on to talk about Home REIT now, obviously completely different circumstances, as I've explained before, completely different to Civitas Home REIT, but there was a big sort of furore this week from Blue Star. So this is a company that was bidding for Home REIT to buy it and take it private. Offered possible offer of 40p per share on the table, and this was since been rejected by the board. The board came out last night and said that this bid would not maximise value for shareholders, and it was no longer proactively pursuing the sale of the company, and is more focused on appointing a new manager to take over from Valvarium. And as you remember, or you might remember, Blue Star is led by someone who used to work for Valvarium. So there's that sort of link there from that. And it's been reported in the press that AEW is in pole position to take over the mandate. So I'll come and talk about them a bit later. But on the next slide, yeah, like I don't think the board of Home REIT has covered himself in glory again through this. Got no idea why they didn't tell Blue Star that they're not considering a bid anymore, the bid was too low or anything like that. Instead, they just sort of cut off communications with them, which led Blue Star to make this announcement on Wednesday. I picked out a few of the quotes there, but they've been frustrated by their lack of engagement, not had any formal response on the offer from the board of Home REIT, and then sort of said that by doing this, they effectively remove optionality for shareholders who, let's face it, are in a sort of pickle here, and some might just want to get out at this price, and not. But in my view, the offer is way too low. It's opportunistic, but yeah, it's not covered themselves in much glory. Again, the board here with this debacle. So that's where we're at really with this. On the next slide, we'll look at AEW a bit more. As I said, it's been reported that they're in pole position to take over the mandate of this. You might not know much about them. They're a US real estate investment manager, about 90 billion under management at the moment. They're across mainly North America and Europe, a bit in Asia as well. In the UK, they're about 1.6 billion under management. You might know them mainly through AEW UK REIT, which is quite a strong performing, diversified portfolio in the UK. But they've also got, I was doing a bit of sort of searching into them to see how what their special, how their skill sets will match up with taking on this home REIT portfolio. So they've got a open-ended fund called the AEW UK Real Return Fund. It's only about just under 200 million. But it has been in the last couple of years increasing its weighting towards non-cyclicals that meet sort of social need, and over 50% of the portfolio is in supported living and care and assets like that. So it does seem they do have a team that can that have the skill set within the AEW UK umbrella that could take on this the portfolio of home REIT and try to turn it around. So yeah, it's going to be interesting to see what happens there. Hopefully there's going to be an announcement soon on the appointment of a new manager, and shareholders can start seeing some positivity from that, because it really needs it. It's been in the doldrums for a long time. So yeah, we'll wait and see on that. Thanks, Matt.
Right, thanks, Rich.